Welcome to The Explainer. Today, we're diving into the dramatic, volatile forces that are battling over the price of gold. And believe me, it's a wild story of powerful policies, absolutely massive debt, and a global economic tug-of-war with trillions of dollars hanging in the balance. So get this, the price of gold, which had been kind of struggling, suddenly just catches fire. It rockets up to a stunning new high of nearly $5,000 an ounce. Now, this wasn't just some random blip on the charts. Oh no, this was basically the first shot fired in a fierce battle between two opposing economic titans, and they have very, very different ideas about the future. All right, let's get into it. So, on one side of this tug-of-war, you've got the bears. And their power comes from a U.S. monetary policy that is just laser-focused on one thing, making the dollar king. That means pushing everything else, especially gold, off to the side. And you know, the market really felt the full power of the bears back in late January. The nomination of Federal Reserve candidate Kevin Warsh, who is well known for his philosophy of tight money, sent absolute shockwaves through the market. Gold plummeted 12% in a single day. So what's really going on here? Well, this slide breaks it down perfectly. It's a chain reaction. This hawkish policy, as they call it, signals higher interest rates. Higher rates make the US dollar stronger and way more attractive to investors. I mean, think about it. When you can earn solid interest from the dollar, why would you hold a lump of gold that pays you absolutely nothing? It just doesn't make sense. But pulling with equal, maybe even greater force on the other end of that rope are the bulls. Now, they're not looking at interest rates. They're staring at a giant mountain of government debt, and they're driven by this deep, growing fear of what it all means. And this is the number that keeps the bulls up at night. The U.S. national debt has exploded past a staggering $9 trillion. For smart investors all over the world, this brings up a terrifying question. What's the real long-term value of a currency that's backed by this much debt? And that is the crucial point here. This fear of currency devaluation is a powerful, powerful counterweight to that strong dollar policy. It's a fundamental fear that, hey, if the government has to print more money just to pay its debts, the dollars in your pocket are going to be worth less. And when that fear kicks in, investors historically run to one safe place: gold. And if you want to see the scale of that fear, look no further. We're not just talking about you and me here. We're talking about global central banks, led by giants like China and Poland. They are buying gold at a massive clip, with some forecasts predicting they'll scoop up 800 tons in a single year. They're essentially building a strong price floor for gold, making a huge bet against the long-term stability of the whole system. Okay, so we've got the bears and the bulls locked in this epic struggle. But this fight isn't happening in a nice, clean vacuum. A few new wild-card factors have just been thrown into the arena, and they're making this whole thing way more complex and unpredictable for everybody. For instance, you've got new U.S. trade tariffs creating this thing called imported inflation. And it's a total paradox. The tariffs are supposed to protect U.S. industry, right? But they also make imported goods more expensive. This forces the Fed to keep interest rates high to fight that inflation, which, you guessed it, unintentionally helps the bears and puts a lid on gold prices. And at the same time, you have all these other forces pulling in different directions. There's a radical plan out there to slash government spending. If that works, it could boost the dollar and hurt gold. You've got cryptocurrencies now competing directly with gold for that safe haven money. And hey, even good news, like a surprise ceasefire in Lebanon, can weaken gold because it lowers the kind of geopolitical risk that often sends people running to it. So with all these powerful, conflicting forces at play, where are the biggest names in finance putting their money? How do they see this tug-of-war ending? Well, the answer, it really just shows how uncertain and divided even the experts are. I mean, just look at this split. You've got titans like JP Morgan and UBS betting big on the bulls, saying gold is going to surge past $6,000 an ounce. But then you have another giant, Goldman Sachs, and they're seeing a much more modest outcome. This isn't a small disagreement. This is a huge division among the world's top banks. And it just highlights the intense uncertainty and the incredibly high stakes of this battle. So what in the world does all this mean for you? It can feel chaotic, even impossible to predict. But here's the thing. Instead of trying to guess who's going to win, the real key is to just understand the conflict itself. Because the price of gold today isn't just about supply and demand. It's not even just about inflation anymore. It is a direct, real-time reflection of this epic tug of war between two fundamental economic philosophies. It's faith in central bank policy on one side versus fear of government debt on the other. And this is the question that's going to define the next chapter for gold. If the bears win, it could signal a period of strong, disciplined economic control, but maybe with slower growth. If the bulls win, it might mean we're heading for some serious currency instability. So watching which side starts to gain momentum, that's the key to understanding where not just gold, but maybe the entire global economy is headed next.